radio for a really great future. We're talking real money.
Hey, everybody. Welcome to another exciting Q&A edition of Talking Real Money. I'm Don McDonald, and this is the show that gets posted on Fridays, devoted to answering the questions that you speak into our website. I know. How does that work? I don't know. It's technology. You just go to our website, which is talkingrealmoney.com, and then you click on the contact button, and then you click on a little microphone, and then you record your question, and then I get it, and then I put it into a future podcast, usually within a few weeks of when you send it in. And then I do them in chronological order as they come in. So I'm not moving anything around for effectiveness. It's like, is this the next one? This is the one we're going to take. And that's why today's episode has a whole bunch of really short questions and then one really long one, because that's the order they came in. So if you want to ask a question, I love answering them. Tom loves answering them. You can send them in on the contact form, either speak them or type them. If you type them, Tom generally does those, or we do them together. If you speak them, I do those on the Friday show. And if you want to talk with us live, there's a really good opportunity for you to do that every single week, except for a major holiday. And that's to call us during the radio show we do in Seattle on Northwest News Radio. And that phone number is 855-935-8255, which spells, if you've listened to talk shows at all, you know what 8255 spells. It spells talk, T-A-L-K, talk. So do that. Talk to us any of those ways, 3 p.m. on Saturdays, 3 to 5, or go to talkingrealmoney.com. Now, let's get the I'm not even going to edit that out. I'm just going to leave it in. It makes me human. Let's get to the first darn question, shall we?
Hi, Don and Tom. This is Mark. I live in Atlanta, Georgia. I'm 64, and within 7 months, I will be turning 65. My wife and I are in the process of sourcing a full retirement financial plan, and we're acquiring different quotes, but we're trying to find what is the the median range that we should expect to pay for a detailed financial retirement plan that we could then take and then use with our financial advisor, whether it's somebody at Appella or somewhere else. But thank you very much for answering, and keep being great human beings. Thank you.
Great human beings. Thank you. That's very nice. That's a great question, and not something we talk about very often. I decided I'd check out the averages because, I'm getting old, and I'm remembering numbers from way back when they were like $1,500, $1,700, something like that. No, the new median, according to a couple of resources, Mike Kitsis says it's about $22,250, and AARP says the average is about $2,500. So that gives us a nice range, $2,250 to $2,500, which is right where I believe we fall. But you're going to find sometimes you'll get a plan if you hire an advisor. You might get that initial plan sometimes. But it's worth having the plan. Oh my gosh, a real financial plan sitting in front of you can provide a wonderful blueprint for what needs to be done. Finally, you can think about it in ways that are logical and strategic. And the other thing it does is it codifies that for you, and it helps emotionally to have a document like that that says this is the path. And you just kind of stick to that path, and most of the time you're in good shape. So yeah, figure about $2,500 is where you're going to end up. Thanks so much for the question, and I wish you well with the plan, and let's get to the next one.
Hi, Don and Tom. I just finished listening to your May 29th podcast, and I just have one question. If we go to a completely cashless society, how do we tip the hotel housekeeping and the bellboy and the valet parking person? Inquiring minds want to know. Thanks.
What? Everybody knows this. You just reach in your pocket, you pull out a Bitcoin. That's all. Just do that. Right. Oh, that's right. There are no Bitcoins. They're a figment of our imagination. They're a very expensive figment of our imagination. Okay. We were talking hyperbolically. There was a little, I don't see us going to a cashless society anytime soon. And you raised some great examples of places where tipping without cash is difficult, but not likely impossible. As a matter of fact, very possible in the not too distant future. Because have you noticed when you go into a restaurant now that almost all the servers have little phone things or little tablet thingies? They just take Apple Pay, or they take Google Pay, or whatever electronic pay system, or Venmo, or PayPal, or whatever it might be, Square. Handheld terminals are going to be the norm. And handheld terminals already exist in almost all of our pockets. So your bellman or valet or housekeeper, bell person, valet or housekeeper, probably has a phone that you could just swipe from Venmo or whatever it is right over to them. It's like flip them $1. As a matter of fact, I know Apple does that. You can just, like, with somebody you're close to, you can just go, oh, here's a person close to me, give them $5. So is it coming? Yeah, it's coming. I mean, think about it. The new AI device that OpenAI is creating with Johnny Ive used to be with Apple. You'll probably be able to speak it. It's just go, oh, my valet at the Hyatt, his name is Juan, send him $3. And it'll just do it. So we will be capable of going cashless, I believe, in the very near future. I think we're almost there. I don't think it's going to happen that soon, but I think we're almost there. I don't even like paying with cash. My wife makes me do it, but I don't like it. I don't like it. Thanks for your question. I appreciate it. Let's go take another that came in through talkingrealmoney.com by going to the contact form and punching on the microphone button.
Hello, fellas. Just wanted to get your guys' take on my portfolio and your thoughts on any changes you would make. But I'm currently 33, all equities. My current portfolio is made up of 85% AVGE, and I also wanted a little more small cap value tilt to even that portfolio, so I added 10% AVUV and 5% the international Avantis, which is, I believe, AVDV. Just want to get your thoughts on any possible changes you would make to that particular portfolio. Thank you.
That is a very nice portfolio for someone starting to build wealth for retirement. It really is nicely diversified. You have a small value tilt already in AVGE, the Avantis Total World Index Fund. You already have some, so you decided to increase it some, which is aggressive, but fine, particularly in the reasonable amounts you've used. It would require a serious quibble for me to have any issues with this mix at all. The only one is I would think that being a little bit more internationally exposed might give you a better planetary diversification. Given the fact that AVGE is already more U.S. than international, and I want to look at the latest numbers because I haven't looked at the portfolio in a couple of weeks. Yeah, see, it's already low. It's 70 U.S. and 30 international, and that Well, even given current market capitalization, that's low. I think you should have more internationally. You don't have to. And again, it's a quibble. It's really being very picky. But instead of doing 10 and 10, I would probably do 7.5 and 7.5 in the AVUV and the AVDV, the AVDV being the International Small Value Fund. So if you want that greater tilt, you keep the same amount of greater tilt, but you just get a little bit more international exposure, which still is not even going to put you at a 2/3, 1/3 allocation because of the fact that the non-U.S. equities in AVGE are less than 30%. So you're not going hog wild by any stretch of the imagination. So that's the only little tiny change I'd make, but it's tiny and you don't even need to do that. Thanks so much for your call and for doing great with your money. I mean, just really a good job. If you're going to do this consistently for the rest of your life, you're going to be one of those people who says, well, I apparently saved a lot for retirement, so I don't really need anything, but thanks for your help. You're doing an incredible job just getting this far at this age. I wasn't there at this age, that age, your age. Another shorter question, and then on to our really long one. So here is that shorter question.
Hi, Don. This is Henry in Kansas City, Missouri. I have 2 questions. After a parent dies, should the executor of the will or the trustee of the estate report it to all 3 credit bureaus to avoid any potential fraud in the future? If yes, what is the process?
I just decided to split this question in 2 parts, given that it's 2 questions. So the first part is alerting credit reporting agencies as to someone's death as executor of the estate, which you really should do because people can still establish credit on a dead person's account. So, yeah, you should notify them, and you should notify them in writing. Look up their addresses online, Equifax, TransUnion, and Experian. Send them a letter stating that you are the executor of the estate for whomever and that you would like to close these credit reports to any future activity. The other thing you can do while you're there is ask for a copy of their latest credit report for every one of them, which you can get, and go through those. That will also give you the opportunity to make sure you've covered all the credit bases of the deceased so that you can make sure all of the credit card accounts and mortgages and all are made current, are paid off, are closed, and made non-active. The only thing you have to send along with all of these requests is a copy of the death certificate. So make sure you get lots of copies of the death certificate. Most funeral homes will give you a ton of them. And also the other people, it's not a company, the other people you might want to contact, even though a lot of mortuaries do this, just double check. Contact Social Security to inform them of the death so that the checks stop. Nobody can cash a check illegally. Now let's go to the next part of the question.
My second question, I'm 62 years old, retired, and inherited an IRA from my father in April of this year. 2026 will be my first RMD from the inherited IRA of about $16,000. I do not need this money since I already have a detailed financial plan that covers all of my living expenses. Since I'm not 70 and a half years old, I know that I cannot make a qualified charitable distribution to a charity in 2026. But can that RMD amount go directly to a charity to avoid paying taxes by transferring it to a donor advised fund in 2026? Or am I simply stuck with accepting the RMD, paying the tax, making the charitable contribution, and then including the donated amount on Schedule A of my 2026 federal tax return? Thanks. Bye-bye.
All right. I have an answer for you that I think you're going to like. I think you're going to like it. Because it happened recently, and you're only 62, you got to wait a while to actually be able to take a qualified charitable distribution. You got to wait until the year in which you turn 70 and a half. You didn't give me your exact birth date, so I don't know the exact time when that can happen. But because this is a non-spousal inherited IRA, you don't have to take a RMD this year. You can take the RMD over 10 years if you want, or you can wait until the end to take it. So you're in luck because it just happens that you're going to squeak in under the deadline, probably. Depending on your age, you will be eligible for a qualified charitable distribution, a QCD, in either 2033 or 2034. All of this money has to come out of the IRA by 12/31/2035. So that means if you take the distribution in 2033, then you take another qualified charitable distribution in 2034, you're done. Or you can take, if you can't take one till 2034, then you can take one in 2034 and one in 2035, and then you're done. Because what you do then is you just take half of the money in each of those qualified charitable distributions, either 2033 and 2034 or 2034 and 2035. That way it can all go to the charity. You don't ever take possession of the money. You don't ever have to pay taxes. You don't have to deduct it on your Schedule A. You just do it. And you're allowed up to $100,000 a year in qualified charitable distributions, so you're in great shape. You could do it all. Actually, you could do it all in 2033 or 2034 if you wanted to. So, but I'd probably just split it in half. Charity gets the money directly, and because you leave it a little longer, they might get more money. However, bear in mind that we're not talking about a huge tax if you just took it, spent it, and paid the tax. But either way, $16,000 is not huge, but it's going to help a charity. And if you're charitably inclined, good for you. Go do it. Thanks so much for this great question, or these great questions. I guess that means today's a 6-question show, because we've got this long one coming up right about now.
Hey, Don, it's Mike from Colorado. And I just first of all want to say I really do appreciate your show, and I get a lot of valuable advice from you every time I listen. So I've got a twofold question. I'm a do-it-yourselfer, and I enjoy doing that, and I'm retired. But I do foresee a time where I will be hiring an advisor, especially for my wife, because she wants nothing to do with this. What I struggle with, and you can give me a good explanation, is assets under management fee versus a fee-only firm. And I believe you, being part of Apello Wealth, you guys operate under the AUM, the Asset Under Management Fee. And here's the problem I have with that, and you can fill me in on what I'm missing here. But if somebody were to have let's just use 1% as the fee charged, which I think is what you guys charge. You might charge 0.5% if it's a higher amount, but it's all relative. So let's just assume 1%, and somebody has a $1 million portfolio. I guess what I want to look at when I'm looking at the numbers is the total amount, not just the percent. So somebody with a $1 million portfolio is going to be charged $10,000 a year by your firm. Somebody with a $2 million portfolio would be charged $20,000. Somebody with a $5 million portfolio would be charged $50,000 per year. What I wrestle with is, let's just compare the person paying $10,000 versus, let's just say, the guy with the $2 million portfolio paying $20,000 per year. Are you going to get twice the amount of service, twice the amount of deliverables, twice the amount of advice, twice the value versus the person that just has the $1 million portfolio and pays half? I guess as an economy of scales basis, I do not understand why it's the same percentage no matter what the volume, what the asset value is. What I wrestle with is going that approach versus just a fee-only firm, which to me seems to make a lot more sense. You're just paying for your services, because I don't necessarily think that it's that much more of a challenge with somebody that has more assets versus less. You're still doing the same balancing of portfolio in respect. So can you expand on that, if you would, since you definitely are, I believe directly affiliated with Apello Wealth. And then the other question I have, you repeatedly talk about you'd go into your own portfolio and you do rebalance, and it sounds like you do it yourself. Are you not even using Apello Wealth when you're part of that organization? Just curious. Unless you're just doing it on your own, and it sounds like Tom lets that company manage his portfolio. So anyway, if you could address that, I would really appreciate it. And again, enjoy your show. Have a great day.
Well, there's a lot going on here, and there are some assumptions that are wrong. I mean, you said it's pretty much 1% across the board, and that's not true. 1% for us is on the first $1 million, and then we drop pretty precipitously in subsequent amounts. As a matter of fact, right now, if you had $2 million with us, you wouldn't pay $20,000, you would pay $15,000. So it's lower the more money you have. Now, yeah, a flat fee advisor is likely to be less expensive. A lot less expensive, not necessarily, because the more money you have, the more complexity your situation has. You're looking at this as if it is merely an asset management fee. And as a pure asset management fee, 1% is too much money. $500 an hour probably is too much money. From a pure, if you're just giving somebody a portfolio, that's not the hardest part of the job. It isn't building the portfolio. It's the other stuff. It's the planning. It's the income generation. It's the process of managing the client. And it's kind of like insurance in some ways. Older people like me generally pay higher premiums than younger people, but it's not commensurate with what we cost. Younger people are paying into the pool so that old people can get the health care they need without breaking the bank. Old people probably cost the insurance companies more than they bring in, but it's spreading the costs out. That's the way systems like this work. And that's a lot of the way investing advice works, because an advisor doesn't spend all of their time just working their clients. They're doing other things too. For example, ours are helping people for free sometimes. So some of that's got to get covered somewhere. But there is a higher amount of work, a larger amount of work that goes into higher net worth clients. They've got more complex estate issues. They often have much more complex planning issues. They have more complex tax issues. So a higher amount, you're going to pay, I guarantee, if you have a per hour advisor and you have $2 million, you're going to pay more per the time you spent with them than you would if you have less than $1 million. It may not be 50% more, it may only be 20% more. I don't know what the exact number is. But the other downside to flat fee advisors or hourly fee advisors is the fact that people, because they're paying by the minute, and usually it's in 6-minute increments, they're reluctant to call their advisor. And they don't want their advisor calling them, because every time the advisor calls, the clock starts running at $500 an hour in the case of the best ones, or more. So you may save a little money. Yeah, absolutely. And I am not opposed to hourly fee advisors. We just found when we started our firm, and I assume Apella found the same thing, just as index fund advisors discovered, and Buckingham and all of the others out there, that financially they just couldn't make a go of the hourly. The hourly is a much, much harder system under which to make profits. And, there have to be profits to us. Well, I mean, how do you think the show gets paid for? Trust me, it comes out of our clients' fees. It has to. There's no other place to get it. It's not like anybody's giving us money to do the podcast. I mean, we have some ads, but those go. Actually, the money we get from ads, we spend on promoting the podcast. We buy ads on Clark Howard. That's all it goes for. So, yeah, we found it made sense. We thought 1% was a fair fee. There are others who charge over 2. I've even found a few who charge 3. So related to those, the one with the declining after the first million is a great way to go, but to each his or her own. And as far as I'm concerned, again, you're looking at it as just asset management. And I made the conscious decision that I really did not want the portfolio, the more complicated portfolio that Appella does. I just wanted to have a simple portfolio, and I did that a long time ago. I did that when it was Vestry because I would have been managing my own anyway, and I didn't want to manage it. Now I could have an advisor do it for me, and it would be totally free. It wouldn't cost me anything. But I probably could make a tiny bit more money. I probably could, and I probably should do it. But we're creatures of habit, and you're right. I actually should do it. The more I think about it, the more I think I should just. But there again, if I did it, most of my money's in taxable accounts, and I'd have all kinds of taxable events that I really don't want right now. So it's more of an inertia thing, It's it's that I've been doing it for so long. I'm just conditioned. It's what I do. But again, the more I think about it, the more I probably should just let an advisor do it because I'm going to get a much better portfolio. So thanks for the idea. Now, if I can figure out how to do it without paying taxes, which is what we all want, right? Thanks so much for the questions. I appreciate it from all of you. And remember, you can call Saturdays at 3 p.m. Eastern time when we do a show on Northwest News Radio in Seattle. That number is 855-935-TALK. And we love talking with you live because there's a give and take. There's a banter, and banter's fun. But these questions work too. Send those in at talkingrealmoney.com on the contact form and take advantage of those free advisors. Just go to talkingrealmoney.com and click on the button that says Meet an Advisor, and they'll meet with you for free, even Tom. And there's no charge, no obligation, no high-pressure sales pitch. And yes, I guess our clients do pay for that, but we all want to help everybody else understand money better, and that's why we're here, being paid by Appella Wealth, to be talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.